Hello, everybody, and welcome to the Nasdaq Dorsey Wright podcast for September 13th. I'm Jay Gragnani here. Joining me this week is Sara. Sara, thanks for joining us. Hope the fall is almost in full effect here in Richmond, Virginia, although it doesn't feel like it today with temperatures getting up into the mid-90s. Feels like summer's come back, but nonetheless, September is here, mid-September is here. And, September is one of those months in the market that is historically a relatively weak month. And we've seen a little bit of volatility creep back into the markets. Nothing of any grave concern by any means, as we continue to see generally positive signs from our equity indicators. But historically, if you just go back and look at the month of September, it is a month that is the worst month on record for the market, going all the way back to 1896, with the S&P 500 averaging about a 1% loss in those years. With that said, in lieu of digging into some September returns like we have in recent podcasts, what we wanted to do today is talk a little bit about some new indexes, and I say newly anniversaried indexes that they came across a 3-year anniversary just at the end of last month, or back in July. And those are a suite of indexes that we call the Dorsey Wright Momentum Plus Indices. And it's a suite of indexes. There's 3 strategies. There's a Momentum Plus Low Volatility, Momentum Plus Yield, Momentum Plus Value, and we'll dig into those in a minute. But really the goal of those indexes, they were launched as indexes back in July of 2018. And really the cornerstone of those investment strategies, as is the cornerstone of our investment process at Dorsey Wright, really hinges on leveraging the power and the potential benefit of relative strength investing. And so with all of those indexes, those 3 indexes, and we'll talk specifically about how they're constructed, they really start with having a momentum or a relative strength filter in place to ensure that whichever other factors we're applying to those, to ensure that the stocks that we are pulling from, or the pond that we're fishing from, is stocked with those stocks that have positive relative strength versus the market. And specifically what I mean by that, if you're familiar with the point and figure method of technical analysis and how we apply that to relative strength, there's basically 4 different categories that any one individual stock can have with respect to its relative strength state. There's a buy and X, so a relative strength chart of an individual stock could be on a buy signal and in a column of X's versus the broader equity market. That relative strength chart could be on a buy signal, but simply pulling back into a column of O's. The third one would be on a sell signal in a column of X's. And lastly, sell signal, column of O's, that last one being the weakest of all those possible combinations. So every single stock within our database has one of those 4 designations. It's either buy an X or BX that we call it, buy an O's or BO, S and X, sell and an X's, that would be SX, and then sell and O's would be SO. So buy an X or BX being the strongest, SO being the weakest. And at the end of the day, when we look at that, what we have found over time, and we've published some research on it, some white papers out there, but what we found over time is the one basket of securities that has shown the ability to consistently outperform not only the broader equity market, but just an equal weighted index of all of those stocks, is that bucket, those stocks that are on a buy signal versus the overall equity market and in the column of X's. In other words, that BX group. So buy signal, column of X's on the relative strength chart. And so that idea, that thought process really establishes the baseline investment universe for this suite of indexes. And so what we do is we start with a very broad, predominantly large and mid cap index, specifically the Nasdaq US large mid cap index, which consists of about 900 of the largest stocks that trade in the US. So that's our starting universe. That list of 900 stocks, we go through and look to see which of those 900 stocks are on a buy signal and in a column of X's on their relative strength chart versus the S&P 500. So that 900 list gets culled down to about 300 stocks. If we were to look at that number today, there's about 300 of those 900 securities that would be in a buy signal column of X's versus the broader equity market. In other words, that list of 300 is our established list of strong relative strength names. From there, we don't simply buy those 300 in the index, but that's our starting inventory. From there, we then apply an additional fundamental factor to those high relative strength names to create the Dorsey Wright Momentum Plus suite of indexes. And so, again, there's some research. If you're interested in reading that, we can point you towards that white paper on the relative strength buy and X bucket. If you're utilizing our database and you want to leverage this kind of concept and idea within your own stock picking strategy, you can very simply use our website to identify which stocks are on a relative strength buy signal and in X's, and then use that as a base inventory. But from there, we use that as the starting inventory, Sarah, and then we apply an additional factor to that list in 3 different capacities. So 3 very different investment factors that we're looking at. Sara, what are those factors that we're looking at? I mentioned them initially, just the 3 kind of concepts, but can you explain a little bit more in detail what that means when we say momentum plus low volatility as an example?
Sure. So like you said, these are very unique indexes that we have developed here. And unlike, a pure momentum strategy, we do see the momentum, high relative strength names, overlaid with those 3 individual factors. So low volatility is one, yield and value. So for low volatility, we're going to take that list that you mentioned, that buy and X list. Those are those strong names that are showing strength in a long-term and near-term fashion versus the broader market. And we're going to rank them by standard deviation. And we're going to buy the lowest volatility names out of that list. Again, they're each targeting about 50 names. So starting with the 900, culling it down to about 300, and then from there, we're always going to end up with 50. So for yields, we're going to sort them by yield, and we're going to buy the top 50 highest yielding names. And then for the value piece, we have a value score that we calculate using 4 different fundamental factors or data pieces, if you will. So that uses price to earnings, price to sales, price to book, and price to free cash flow. So all of those different scores in aggregate, we come up with a value score, and then they're ranked by that value score. So this allows us to, we've said in the past, play the piano with both hands. Not only are we, targeting those high relative strength names, but we are targeting those various factors, which makes these indexes really unique. And like Jay said, on Friday, we did publish a feature on them. So if you're looking for more performance information or for more on the construction of these different indexes, I highly recommend going back and checking that out. But, Jay, we were talking about, again, like the performance, you can go back into the feature, but just the fact that, although these are relative strength and momentum strategies, that, they don't necessarily act like a pure momentum strategy, when looked at in terms of correlation, for example.
No, you're absolutely right. I mean, the momentum piece of these indexes are really designed to be an initial filtering factor in there. It's not in there really to be a momentum index, if you will. As a matter of fact, when you look at correlations of the momentum plus low volatility compared to say the S&P 500 low volatility index, or the momentum plus value versus a value counterpart and yield as well, is the correlation of all those relative to their respective benchmarks is high 90s. You're looking 92, 93, 94% correlated, way higher than the correlation to a pure momentum index. And that really suggests to us that while there's a momentum screen in there, they really do tend to act much more like that other factor, whether it be value, low volatility, or yield. And so these are our indexes, the investment strategies, that the methodologies really are designed to exploit that other fundamental factor, while using momentum, as a filter. And in some cases, like in the case of a value strategy, that momentum filter has the ability and potential to help us avoid some of those stocks that may fall into the value trap categories that are great value stocks and just keep getting better values because they're going down in price. Well, that momentum filter, that's going to weed those types of names out of the portfolio and to make sure that they don't find their way in there just because their prices are continuing to get hit there. So back to your point, Sarah. Yes, while there's momentum in the ingredients, there's momentum built into the sauce. It really is, an initial screening process that's designed to be that filter, but also still have the ability to leverage and exploit those other fundamental factors out there in the marketplace. And another unique aspect, I think, of these is while there's some other strategies out there, there's some other indexes that will constrain either the holdings or the sizes. These really have the flexibility to go where they need to go to identify the leadership trends within those factors because they're not sector constrained. I mean, we can see very meaningful differences and very meaningful changes in those sector allocations over time.
Yeah, so for one example, looking at the Dorsey Wright Momentum Plus Yield Index, looking at the utilities exposure over time. Back in 2017, we saw the exposure tumble, and even just this year, looking back, April 2020, looks like that index had about 28% utilities exposure, which one would expect for a high yielding strategy. But what's really interesting is the next quarterly evaluation. So it's going to be January, April, July, and October that we saw the exposure fall down to about 5%. So it dramatically, cut its exposure when utilities, became weaker. It was harder to find those strong names within that sector. You can see, we know that utilities has been a weaker area this year. It has picked up a little bit of steam here, but really it has been a laggard. So we really did capture that particular trend. And what I find interesting too is today there's not any utilities exposure within the yield index, and there hasn't been for the past two evaluations. So whether that's going to stay the same or change, we won't know until October. But it's a good proof or a good sign that, there's no sector constraints. So we're able to move in and out of those sectors, as long as they fit and they fit with that, the factor score or the factor overlay. It's again, referring back to Friday's piece, I highly suggest if you're looking just for historical exposure, we put some good graphics in there that show that just how, again, utilities, we've seen it be up to about 30% of that yield index, but we've also seen it fall sharply when it needs to. So we definitely have rotated out. As Jay said, sometimes it's about what you're avoiding than what you own. So here we definitely are seeing the strategy sidestep utilities exposure at the moment. So we'll see again in October if that's able to hold. I think that'll be a really interesting evaluation just to see kind of how things have shaken out, just with recent trends and how we've seen utilities, move up in the dollar rankings overall. But like you said, these are not sector constrained, so they do have the ability to move around, and they're just a really, really unique strategy.
Yeah, and I think I probably failed to mention it at the beginning, but they are strategies that are dynamic in nature in the sense that they're evaluated 4 times a year. So once a quarter, not calendar quarter, but once a quarter, they are evaluated for holdings, and that evaluation, there's 2 things that are going on there. There's one is the initial relative strength or momentum filter that is being reevaluated. So we're dumping all of those 900 stocks out again and culling that list down to those stocks. I'm saying about 300. It's that number can change a little bit from quarter to quarter, but about 300. And you're seeing another filter laid on for the fundamental factors. So you're getting the initial momentum filter and then the other factor filter. And in the case of, I think it's really interesting, Sarah, your point on the utility sector and dividend. I mean, you think a lot of dividend strategies are very heavily weighted towards utility stocks just because there's a lot of yield in utility stocks. If certainly that's good. If interest rates are not going straight up, those stocks can benefit. Or the indexes can benefit from those big yields. But if you get, a sector like utilities that is interest rate sensitive, the Momentum Plus Yield Index has the ability, and we've seen that actually shine through to underweight sector and be completely out of a sector like utilities to search for yield in other stocks that are stronger from a price performance perspective as well, but still also has a good dividend yield attached to it. So if there's anything that, that we can help answer, if you have any further questions on any of the Momentum Plus indexes, again, the Momentum Plus Yield, Momentum Plus Low Volatility, and Momentum Plus Value indexes, please don't hesitate to reach out to us. Happy to answer any questions for you as it relates to what's in there now. The next evaluation for those will be coming up in October. So next month, we'll see another evaluation, go through those and see what stocks move in and out of there. But please don't hesitate to reach out to us. You can reach us at email, dwa@dorseywright.com. Phone number is 804-320-8511. So if there's anything we can answer on those indexes or anything else we can help you with, please don't hesitate to reach out to us. In the meantime, appreciate everybody taking time to join us. Sara, thanks for being on this week, and look forward to talking to everybody soon.